Boom. All right. So it's class number 3, guys. First class, we got you introduced to what the idea of Forex is, who trades in it. Basically, we went over the what, when, where, who, why, right? So now we're going to get a little bit more technical tonight. But before we get to like looking at the price and the movement of a market, I want to touch on this subject right now, and then we'll go deeper into it later once we start on the strategy, okay? That subject is risk management, guys. I cannot stress, I cannot stress how key this will be to your success as a trader. Risk management. It is the second biggest factor to a successful trader. So we covered last week, the first key element to a successful trader is your mindset and controlling your emotions, right? This is the second, guys, okay? But notice though, those two things have nothing to do with actually trading, okay? So you guys, again, I'm gonna emphasize this until the end of the course. Work on your mindset, okay? I like something in one of the group chats that one of the leaders actually put into it. I'm gonna read it to you guys. Hold on, let me find it for you. It says, words are spells, and that's why it's called spelling. Another thing you need to remember. I feel terrible. You say that, right? So you're going to feel terrible. You feel great. I feel great. You're going to feel great. Okay. So again, your success is based mainly around your mindset and your risk management. All righty. So risk comes from not knowing what you're doing. Guys, we're teaching you what to do basically. All you guys have to do is follow the blueprint. And if you deviate a little bit from it, that's cool. That's fine and dandy. But at least stick to the basics of the blueprint, because at the end of the day, what I'm teaching you is mainly a price action system. All righty. Hold on real quick. I got to get this out of my way. There we go. And that quote comes from Warren Buffett. So basically, once you know what you're doing, guys, I mean, your risk becomes lowered. It becomes less of a gamble for you to enter the market. So what is the risk and how do you manage it? All right. So each trade carries with it a certain level of risk. And prior to entering a trade, you must be aware of the amount of risk that is involved within that particular trade. That's one of the reasons why I went so in depth into the calculation of a PIP, going over leverage and margin and things of the sort. Risk is a highly important aspect of trading. So knowing the amount of risk on each trade is one way to limit and protect your capital. 4 things you must do to manage risk and have longevity in the Forex market. You got to identify your risk. So you want to identify a potential buy or sell. Okay. You want to assess that buy or sell, assess the risk, right? That means assess a potential stop loss and take profit level. All right. The third thing you got to do, guys, is control the risk. Set your lot size properly. The 4th thing is review everything that you just previously did. Does it follow your trade plan? So does it stand within the parameters of our risk management? Is it a minimum of 2 to 1 risk to reward ratio? Cool. Now, how much are you risking on that? Are you risking again between 1 to 5% of your account? That's what that means by control the risk. All right. So identify the risk. We'll touch on this. Know what type of trade you are speculating, guys. All right. And with the time frame correlation, which that's something we get deeper into later, it helps you choose between whether you're going to be a position trader, which is held for more than a day usually. Is it a swing trade, which is held for 18 to 16 hours, if not potentially longer? Is it a day trade? And we'll refer to anything held for 1 to 8 hours as this type of trade, okay? Or is it a scalp or short term? And that's any trade held less for than an hour, right? So that's a short term trade. These to the right is a diagram. There are many types of traders. Of course, you got to find out which one you are: a scalper, day trader, swing trader, or a position trader. Basically, what this means is if you're a scalper, you trade like the shorter time frames, basically anything less than the hour time. Okay. If you're a day trader, it says you take trades on the 5 to 15 minute chart, but the way I have the system is set up, you enter off the 5 or 15 minute chart, but your structure is found on the 4 hour or the 1 hour. Okay. Are you a swing trader? Again, you're talking about anything longer than an hour, anything longer than 4 hours. You're on a swing trade. Then are you a position trader? If you find structure on the daily chart, you're looking for a long-term position, guys. All right. And the system that I'm going to teach you guys helps you determine based on time frame correlation, what type of trade you're entering. The next thing you got to do, guys, is know the type of trade. So we use time frame correlation to determine the type of trade we enter. All right. So if you're on the daily time frame, again, you're entering a position or a swing. That's going to have the largest stop loss in pips. And this is why it's so key to understand what type of trade you're entering, because each type, guys, is going to have a different margin or a different width in the stop loss. All righty. If you're on the 4 hour chart, guys, that's going to be a swing or an intraday trade. If you're on the 1 hour, you find the structure on the 1 hour, that's going to be an intraday or a short-term trade. That's going to have the smallest or the thinnest stop loss in pips, okay? Anything less than the 1 hour, guys, you're looking at a scalp. Each trade will have the same risk management parameters of, you got to have your entry and exit points. So your entry and take profit, right? A take profit and stop loss. Then you have to know your lot size based on your stop loss. And then you're going to be risking in between 1% to 3% typically. All right. Now, sometimes people get a little bit ballsy and go a little bit higher than that, which is okay. But you have to understand, depending on what type of trade you're entering, guys, the values of those are going to be different. Because again, your stop loss for a swing trade is going to be wider than the stop loss for an intraday trade. Okay. So control the risk, the calculation. Risk amount in dollars divided by the stop loss size is going to be the correct lot size to stick within, guys. And then, of course, you want the parameters to be a minimum of a 1 to 2 risk to reward ratio. The first step is to determine and decide the amount of risk you wish to place. This should be determined by your account size. You want to risk, guys, recommend starting out in between 1 to 3% of your account. So, for example, hold on. If you have $1,000 in your account, 3% of that, guys, is $30. So that's going to be your risk, or how much can you go into drawdown, right? A good risk to reward ratio would be 1 to 3. So you're going to be risking 3% to gain 9%. So you're going to risk $30 to gain $90. All right. So let's say you have a valid setup which requires a 30 pip stop loss. To work out what lot size, guys, that is relevant to what you would do is you take the $30, which is the 3% risk, you divide that by the stop loss, by the number of pips for your stop loss. That's 30. That equals $1 per pip. All right. What lot size pays out approximately $1 per pip? It's a mini lot size of 0.10. All right. And that's the math behind entering properly for your risk management. Okay. And we'll always cover that again, guys. One more example. Let's say your account size is $5,690. You only want to risk 2% this time, as you are being more conservative, right? 2% of the $556.90 is $113.80, guys. $113.80. The required stop loss is 55 pips. So that right there is letting me know that I'm either entering a swing trade or a position trade, right? So we do the calculation again. You take the 2% risk amount divided by the stop loss amount, and that equals out to be $2.06 per pip. The lot size that would equate to would be approximately the 0.20, another mini lot, which pays out approximately a value of $2 per pip. Okay, are you guys following the math behind that yet?
Yeah.
Yeah. Yeah, it's making sense.
All right. Come on, get out of here. Okay, so let's review this. The review part of the risk management, guys, is does everything align, right? There will never be a trade that you should take that is less than a 1 to 2 risk to reward ratio. It's not going to be worth your time. As long as you follow this, guys, you can potentially be a 50-50 trader and still come out net profitable. So I need you guys to understand that, guys. You don't have to win every trade. With the risk management, what we're teaching you guys, again, you can be a 50-50 trader and still be net profitable. Okay, just make sure all your parameters for the follow the proper risk management. That's all you got to do. So that's the quick lesson on risk management. That's the end of all pretty much the boring stuff, right? So now we're going to move on to like the fundamental and technical analysis. So fundamental analysis, guys, this is the news portion of trading, right? Here's a little quote. In order of importance to me are number 1, the long-term trend, number 2, the current chart pattern, and number 3, picking a good spot to buy or sell. The reason why this quote is in here, guys, is because of the system that I'm trying to teach you guys. Ed Sequoia, he's a top market trader and commodities trend trader, right? Brilliant guy, super smart, all kinds of stuff. His 1, 2, and 3, guys, are the 3 charts we look for. We look at the long-term trend. On our structure chart, we look at the current chart pattern on our setup entry chart, and then we pick a good spot to buy or sell on our candle entry time frame. So what is fundamental analysis? Every day, guys, the market sees the release of important pieces of economic data, be it the Bank of England regarding inflation or jobs numbers, or the Fed minutes, the USCP or manufacturing numbers, or the euro interest rates, whatever it is, okay? This is what we call macroeconomic data. And these data releases impact price action, both long-term and short-term, depending on the type of release. Fundamental announcements are a vital part of trading Forex, stocks, and pretty much all the financial markets. They help to move the markets along a little bit faster, creating huge liquidity in short periods of time. They also create a lot of volatility. This combined with liquidity can be taken advantage of, though. The general consensus is and always has been the markets will follow the economic numbers. Okay, but in Forex, fundamentals mean we are basically pitting one economy against another. So we've got United States versus the British pound. That's the United States economy versus Great Britain, right? We got Australia versus Japan. That's the Australian dollar versus the Japanese yen. Switzerland versus USA, Swiss franc versus United States dollar, and so forth, right? To check for news, guys, we use a couple of different websites or an app. You can use investing.com. You can use the FX Street News app. They've got a website as well. And I personally use forexfactory.com. And I'll touch on that, guys, here in a little bit as far as how you read the news. What's the difference between fundamental analysis and technical analysis? There's a little chart to the right. So fundamental analysis is the most useful to predict long-term trends. It's a must for a long-term investor. Technical analysis, though, is most useful for, you know, short-term trends, or a must for a trader, which is you and I. Earnings, NPM, balance sheet, cash flow, promoter holdings. Those are type of instruments, or I should say indicators that come along with fundamental analysis. The equivalents of that in technical analysis would be like the Bollinger Bands, EMA, stochastic, the RSI, and Fibonacci. Fundamentals do not change based on external news, okay? They don't change. But the external news can defy technical analysis, okay? If you're trading commodities, there's not much fundamental analysis for that. But on the other side, for commodities, there's only technical analysis and indicators. So I'm going to introduce you guys to just a few of the most important news releases. I'm not going to go too in depth on them, guys, but it just gives you an idea of what type of news release it is, right? Interest rates and higher interest rates, they cause a currency to appreciate in value due to an increase in investment under highest interest rate climates. However, a strong currency had its own issues. It will make exports more expensive, and higher interest rates also could cost of borrowing more, make the cost of borrowing more expensive. Lower interest rates cause a currency to devalue. There is less investment due to the lower rate of return. Interest rates also drive the flow of money, which is a very backbone of the Forex markets. Manufacturing data. This is a strong indicator for industrialized countries. It is bullish if the nodes are higher than expected and bearish if the nodes are lower than expected. We'll go over that once I show you the website. Employment data. Higher employment nodes will be bullish for that currency, as lower employment will be bearish for that currency. Inflation and consumer confidence. Higher inflation and higher consumer confidence is a positive economic signal and therefore has a bullish effect on the currency. Yet again, weaker inflation and consumer confidence is a bearish signal for a currency. And you can honestly tune into like Bloomberg and things like that to figure out, find out about the news releases and what they're saying about it. You've got the GDP, the gross domestic product, considered more of a lagging indicator, but of course a higher GDP encourages bullish price action, and it's the opposite for the bearish, a lower. So your job as a Forex trader, before even opening your charts, would be to look each day at an economic calendar to see what type of fundamental analysis could affect the markets and the currency pairs that you're looking to trade at, guys. Non-farm payroll, guys, is every first week of the month, and it is one of the biggest, if not the biggest, fundamental news release. Okay. A statistic research recorded and reported by the United States Bureau of Labor Statistics intended to represent the total number of paid U.S. workers of any business, excluding the following types. So they're excluding government employees, private household employees, and employees of nonprofit organizations that provide assistance to individuals, and farm employees. So outside of those four categories, guys, everything else is included. This monthly report also includes estimates on the average work week and the average weekly earnings of all non-farm employees. The total non-farm payroll accounts for approximately 80% of the workers who produce the entire GDP of the United States. That's why this is such a huge news release. The NFP statistic is reported monthly on the first Friday of the month and is used to assist government policymakers and economists to determine the current state of the economy and predict future levels of economic activity. NFP creates a lot of volatility and havoc in the markets. Straight after the data release, there will be a sudden spikes in price across all the USD pairs, guys. It is advised for you to stay clear from NFP day and start trading the following week once there is a stronger sense of direction. That's as new traders. Once you all get comfortable, you'll be trading it. All right. Any questions before we get started on technical analysis?
Nope, not yet.
All right, cool. No. All right, so let's continue on. So technical analysis, guys, this is where we thrive at, basically. This is getting into the candles, market structure, all that good stuff, right? Let's get started. So you need a well thought out plan which anticipates all potential scenarios to keep you from making impulsive and emotional decisions during market hours. You are being bombarded constantly with new information from peers, television, price action, websites, etc. Trading stocks is a business, guys. And if you want your business to thrive, you must have a plan in which you execute flawlessly. That's from Brian Shannon in his book, Technical Analysis Using Multiple Time Frames. Again, what I'm teaching you guys uses multiple time frames. So now you've got two people who have reference using multiple time frames or time frame correlation in some way, shape, or form, right? That's what I'm teaching you. Another thing is I'm giving you guys the plan to follow. So you don't necessarily have to recreate the wheel, guys. Just follow it. Okay? Add things to it here and there that may help you, but just stick to it for the most part. This is what we have coming up, guys. We're not going to get through all of this tonight, but as you all can see, it gets pretty good now, right? So tonight, what I'll cover is market movement, support and resistance, market structure, looking at a trending market versus a consolidation market, and the different types of candles. We'll possibly take a look at the MACD and exponential moving average. I don't think we'll get that far to it, but this is what we've got coming up over the next few classes, guys. It's especially on the deeper study, concepts taught under the Sherpa system. This is where we get deeper into the key levels, which is the quarters theory. We get deeper into the market cycle, which is Elliott Wave. We get deeper into market structure. We'll be able to identify major and minor structure. We'll take a look at a proper breakup structure. Then we'll get into the time frame correlation, Fibonacci retracement, order blocks, market patterns, specific candle patterns we look for, market timing, divergence, things of the sort. So we got a lot to cover, guys. So let's start with the market movement. The market movement, guys, is never a smooth ride. Okay, it's never a pedal to the floor bull run. It's never a pedal to the floor bear run, right? It's never going to go straight up. It's never going to go straight down. It moves how it moves, and you just have to learn it, okay? The currencies are neither appreciating nor depreciating, guys. There are popular sayings on Wall Street which you should live by as a trader. Never go against the trend. The trend is your friend, right? Those couple of phrases right there, guys, again, write them down, keep on your trade journal, whatever you call it, but never go against the trend. The trend is your friend, all right? By looking for entries within a trending market, traders have the best chance at making a large profit on their risk. Traders who continuously attempt to trade against the trend by attempting to choose the top and bottom of the market generally lose quite rapidly. The three market trend methodologies explained above are the core price structures and rhythm of all markets. To successfully trade in the Forex market, you must understand the underlying movements, the rhythms, and how to recognize future turning points. The markets always move within the framework of an underlying market wave or an underlying Elliott wave, and that's pure price action, whether it be up, down, or sideways. So what is an uptrend? What is a bull trend, right? An uptrend or a bull trend is the same thing. It's where you want to be buying, all right? Let me see. So uptrend is when the bulls command the market. An uptrend is considered to be in place when a market is making higher highs and higher lows. Once established, only buy positions are to be taken. An uptrend, also known as a bull trend, is identified by a series of rallies where each rally or swing exceeds the highest point of the previous rally peak. The decline between the rallies ends above the lowest point of the previous decline. So over here on the diagram, starting with this most lowest point right here before this HL, this is your low, then it drives up, makes a high. On this retrace right here is where we would fib from this low to this high to measure how deep the retracement is against this move and wait for it to make a higher low. Once we see it maybe rejecting off of some type of market structure, we're reading the price action to catch this move, to catch the buy, or enter for the buy to catch this move. Once we fib from this low to this high and catch this move, our Fibonacci extensions are going to be equal to this move right here. I know, Gunnar, you was asking or saying that you didn't feel comfortable with the holding a trade to a certain extent or something like that, but this is the reason why we use the Fibonacci extensions as our TPs. All right, so
Yes.
a low, a high, higher low, higher high, higher low, higher high, higher low, high, right? And then you've got this retracement, which creates a low, a lower high than this high now, and it's going down. Okay, that's the bull trend. The downtrend is the exact opposite, guys. Okay, and also understand. I think Gunnar asked a great question about Elliott Wave last night too. Is it only run on a bull trend? No, it's going to run in a bull or a bear trend, and we'll get deeper into that as well. So in a downtrend where the bears control the market, a downtrend is in place when the market is making lower highs and lower lows. Once established, only sell positions are to be taken. A downtrend, also known as a bear trend, is identified by a series of rallies which each rally exceeds the lowest point of the previous rally, rally decline. The incline between rallies ends below the highest point of the previous decline. So you got this high, you got a low, a lower high, a lower low. These red lines, guys, delineate breaks of structure, basically, okay? This is a lower high, a lower low. That's letting you know if the market's making lower lows and lower highs, guys, you're in a downtrend. What's a consolidation look like? It's either a sideways move or it's also known as Medusa. It's not going anywhere, guys. It's just ranging in between a support and resistance, right? Trading a sideways market is also known as range trading. It involves trading a market that is consolidating between obvious support, which is the bottom line, and resistance, which is the top line. Another term I like to call these guys is a support is a floor, right? You stand on support, and a resistance is a top. So if you jump and hit the ceiling, that's resistance, right? So I call the top a ceiling. So it's consolidating between the floor and ceiling levels, the high and low of the red line, often resulting in high probability entries with good risk to reward ratios. Now, I do want to warn you as new traders, guys, you don't want to, I guess, try to take these trades because again, this is a consolidation. And if you get on the wrong side, you could potentially lose. We don't really know which way it's going to go. It's kind of a period or a moment of indecision in the market. All right. But trade signals are given near to these levels where the price is likely to bounce from. Eventually, the market will find its direction and break through one of those key levels. Support and resistance, or the ceiling and floor, right? Support is market structure that price uses at a floor to bounce up. To the picture to the right, that's the green line. Resistance is market structure that price uses as a ceiling to reject off of and go down. And that's the red line on the diagram at the top to the right. That is a bull trend. As you see, it's making lower highs and higher highs. Higher lows and higher highs, right? Your higher low comes at your support. Your higher high comes at your resistance, right? Here's your high, higher low, higher high, higher low, higher high. Looking at it like this, support and resistance, they flip-flop, guys, okay? So looking at this move right here, you've got this support. This was resistance, right? Because it hit this and bounced down. But when price breaks above the resistance and comes down to test that structure that was broken, it now becomes a new floor or support. So over here, when price was below it, it's resistance. Now that price is above it, it's going to use it as support. Market structure. Now we're getting good. So market structure, guys, is typically, major market structure, I should say, is typically found at the swing points for now, all right? Market structure is an area of great significance when dealing with technical analysis that's surrounded around price when it approaches support or resistance. There's major and minor market structure. We just have to know the difference between the two. For now, we'll only focus on the major market structure because that's usually found at the swing highs or at the swing lows. I got that backwards. At these critical areas, we can speculate that what the market will do on the future-based price action and historical price data. At these areas, different types of candles form, which is the price action we read, guys. And I'm gonna cover a few of those candles tonight. Retracements. Retracements are counter trends, okay? Once price hits support or resistance of a floor or a ceiling, it will enter a retracement or pullback against the prior trend. These retracements are measured using the Fibonacci retracement tool. It is within this pullback where we find our entries for trading. We cover trends and retracements more in Elliott Wave, all right? But on this diagram to the right, so using this bull run, we have this low, this high, a higher low, higher high, higher low, higher high, higher low, high. This move right here is a counter trend trade to the impulse or the bigger move. So this is a retracement, all right? This is a push or impulse. This is a retracement. Another impulse or push up that breaks structure. This retracement or pullback is a retracement. That's what I'm talking about in these retracements. They're counter trends. These are the moves, guys, that you don't want to be trading with yet. So if you're seeing a long or a big trend, guys, and price is looking down, understand that, you know, until it crosses this low, it's just a retracement. And we'll get deeper into that. Here's the good shit. We're getting into the types of candles that are found at market structure, okay? And we're also going to tell you what some of these candles mean. At these areas of market structure, price action paints candles that tell tales about future price movements. An arrangement of candlesticks are known as patterns, that we recall for future reference. These are like your head and shoulders. These are like your three soldiers, or your three white Russians, so forth. Each individual candle within a candle reversal pattern tells a story about who is gaining control of the market, the bears or the bulls, the buyers or the sellers, right? A few different candle bar formations include the doji, spinning top, the hanging man or pin bars, the engulfing candle, which is a favorite, something you really want to hone in on, the MARUBOZU, which is the favorite, something you really want to hone in on. But when these candles come together, guys, they create different reversal patterns, and they are a great deal of reversal patterns that can form over and over. We only focus on a few high probability patterns for our setups, okay? So what is a doji? A doji is relatively a weak candle, all right? The open and close price is virtually the same. Remember, going back to lesson 1 or lesson 2, showing you guys what the candlestick is and things of the sort, right? What an open and close price is. The open and close price is virtually the same. The bodies are short. What a doji suggests is indecision or a battle between the buyers and sellers. It also has various forms. These are the various forms over here. Pay attention to the preceding candles, and I want to say pay attention to the next couple of candles after it. What a doji means is equilibrium between supply and demand, or buyers and sellers. So a normal doji just looks like a plus symbol. So this is a long leg doji. It's a dragonfly doji, right? Right, this hash right here, guys, is the open and close. The open and close is virtually the same. That's why it doesn't have a body. Spinning tops. Spinning tops are still a relatively weak candle, guys, okay? It'll have long upper and the long lower wick with a small body. Of course, the color of the candles or the color of the body is not important. And again, all it means is indecision between buyers and sellers. That's all it means. The hanging man. So it's a bearish pattern formed at the end of an uptrend. We call that a hammer at the end of a downtrend. Okay, it's identified by small bodies with long lower shadows or wicks. So the hanging man at the end of an uptrend, you've got this hammer. It can be red or green, it doesn't matter. At the end of a downtrend, it'll be the opposite. So just flip this image upside down, basically. What is a pin bar? A pin bar are also called shooting stars. There's a few different other types of pin bars, but this is the strongest one, shooting stars, okay? Created when an open, close, the open, low, and the close price are roughly the same, all righty? So you'll have a long upper wick or a long lower wick, depending on where it's forming. And the wick, guys, is generally 2 times the length of the body. So if you're looking at a chart, and I'll show you here on the chart in a little bit, and a candle has a long wick like that and the body's super short, just identify that as a pin bar. This particular pin bar means the sellers reject the buyers because it's at the end of an uptrend. The long wick means market tested a resistance or support and equity was located. It reached there, maybe hit some people's stop losses and buy stops or buy limits, whatever you call them, and got the hell out of there. It indicates the prior trend is about to end and may begin to downtrend or consolidate. That's what a shooting star tells you. Shooting stars are found at the end of an uptrend. The MARUBOZU, typo. This, again, is our favorite entry candle. Pay attention to this candle, guys. It's got no wicks at all, or it's got very, very small wicks on them. So depending on the color, the high, low, or the open close are virtually the same. So what that means is, using the diagram to the right, on the green bar, you've got the open price, and then you've got the close price of that bar. So the open and closing price are going to be virtually the same for the next candle, that red candle. The closing price is virtually the same as the next candle's open price. That's what it means. So when you see this, guys, it's going to be either a continuation or a reversal. It just depends on where it's at. All right. If we see this formation, it's very powerful on the weekly and daily charts, as that will potentially allow you to enter a swing or a position trade. The engulfing candle, this is our next favorite entry candle. I will say you will see more engulfing candles than the MARUBOZU. All right. The engulfing candle, a bullish engulfing pattern, which is the top picture to the right, is usually found at the bottom of a downtrend or consolidation range at levels of support. And then the bearish engulfing pattern is found at the top of an uptrend. All right. What an engulfing candle is, or an engulfing pattern, I should say, you have on the first candle before the big candle, the small bearish first candle, followed by the larger bullish candle. That's bigger in body and size. So in the top image, you've got the small body, the small red candle, and then you've got the big bullish green candle. That's telling you momentum and who has control of the market. They pretty much swallowed the previous candle, right? The greater the size, the more strength the buyers has And of course, the greater the size, the more strength the sellers has, depending on which bearish engulfing pattern you're looking at. The morning star. This is an okay pattern, but understand that this takes 3 candles to paint. So you've got the first bearish, the second middle, and the third. Okay. It starts with the bearish momentum candle. The second candle is either a hammer, doji, or a spinning top. The third candle must close within the upper 40% of the first candle. So let's break this down. This is your first candle. This is a spinning top. This third candle has to close within the first 40%, okay, of this candle. And this is getting into the details of voids, actually, off of engulfing.
Hey, Corey.
What's up?
If you're using your mouse to show us stuff, we can't see your
You
mouse.
can't see him. You can't see my mouse, huh? Oh man.
No.
I appreciate you letting me know that. That's
I
crap.
was gonna say the same thing, but I thought you know that.
I had no clue, bro. I gotta figure out how we're gonna do that because I was trying to point at something. Thank you for that. So an evening star, guys, is the exact opposite of the morning star. Let me see real quick. Yep. The first candle is bullish. The second candle has to be a shooting star, doji, or a spinning top. And the third, again, must close within the lower 40% of the first bullish candle. An inside bar. This is this is more of a trade setup, I should say, than it is a reversal or anything like that. So to explain it, you've got 2 candles that has to be formed, okay? The second candle is contained. So picture it as like a reversed engulfing candle, all right? This is the opposite of an engulfing. It's a high probability setup based off price action alone, and the formation indicates a time of indecision or consolidation. And typically at the market consolidation it typically occur after a market consolidation after a large move. And then, of course, they can form in key areas of support and resistance. So this is what an inside bar is. There's your mother bar, and this bar is contained, or the body of this bar can be swallowed by this bar, basically. That creates the inside bar. Like I said, it's just a reverse engulfing. But if you see that, guys, you know, it can give you a nice potential for trade entry. We'll go deeper into it. All right, so let's stop right there, okay? And let's take a look at these charts real quick. Before we get into that, I'm gonna open up the floor for any kind of questions.
Do you got are those all those candle patterns like should you really study those and know them like before you really get into all this?
Before
Not like making trades and stuff like that. Like I'm like, trades.
No, so I wouldn't say you have to like memorize them or anything like that. The 2 that I would really memorize, guys, would be like the engulfing candle or the MARUBOZU. Okay. Now it's good to know what those candles mean and why they paint at certain areas, because then that allows you to read the price action better. So that's why I go over those candle patterns for you. Let's take a look.
I have a quick question.
Go ahead.
So, like, I guess for your personal routine, do you like to look at the news, like say like maybe 6 a.m. to kind of before you even do your charting or anything, being like, all right, this is what the market is looking like, this is what they're talking about, and then you go into your trading?
Correct. I'm going to show you guys the how to read the news real quick, and then we'll look at these charts actually.
Got you. Thank you.
Because yeah, before you enter a trade, you want to be aware of what type of news is coming out for what currency. So that way, if you're trading on that currency, you know, hey, there's some potential momentum and stuff like that coming out. So Let me.
Hey, can I say something as well, Corey?
Yes, sir.
For all the new people, the Candlestick Bible book is really good. It goes over all what he just went over, and then really good explanation. And it helped me out when he was just explaining all that. So if anyone wants something to read and just to freshen up something, the Candlestick Bible is a really good book to read, in my opinion.
Quit playing.
And I hate reading, by the way. And I read the whole thing.
Likewise, bro.
All right, so this is Forex Factory, guys. This is the website I use to check for news before I enter. If there is a red folder, that's news that I write down, and the time that it releases and stuff like that as well, because that's going to produce a lot of volatility in the markets. So when you come to forexfactory.com, this is all you see. Well, that's not the home screen, I don't believe. Okay, so yeah, it is. Up here at the top, you want to click on calendar, and it's going to pull up all the news releases for that week, right? So you can take note of any major news releases that's going to be coming out for any type of currency that you're going to be trading. Now, all these news releases, we don't necessarily need to pay attention to, okay? Yeah, what's going on with my internet? What we pay attention to are things like this orange folder when their president speaks. That's going to create some type of volatility to the market. We definitely pay attention to the red folders. All right. Now, here's what you don't necessarily have to know how to do it, but it's just good to know, right? So this is red folder for United States dollar. If you're trading anything with the United States dollar, you want to be aware of that and of what type it is. We click on this folder to open it in detail. Here's how we read these numbers, guys. All right. So the historical, this was last month's release. Okay. Last month had a forecast of 1.3%. Okay. And this core retail sales is basically it's telling you how well did retail stores do. Okay. So they predicted or forecasted a increase of 1.3%, right? The previous increase was 8.3. The actual was 1.9. Okay. Since the actual was better than the forecast, what do you guys think happened for the United States dollar?
It went up.
Went up.
There we go. Now, down here in May 15th, right? The forecast was a negative 8%. It was terrible. It was expected to be terrible anyways, right? But it was even worse than what they forecast. So what happened?
Went bearish. Went down.
And that's all reading the news is, guys, right? Just understanding what these numbers mean, why it's like this, and how it affects the market, basically. So if it's green, it'll be good for that currency. So here's how we use that, though. So understand that this was for the United States dollar. Okay, now let's go to, let me see, let's go home real quick. So depending on where the United States dollar is in the quote is going to affect the charts differently, okay? So for instance, the euro versus the United States dollar. Since last month was good, so it strengthened the dollar, it made the euro versus the dollar go bearish. Okay? But since USD JPY, this is one United States dollar versus the yen, right? So we're looking at the United States dollar at this chart. Since it was good for the dollar, this chart should have went up. Okay, so again, depending on where the currency is that you're speculating on and what type of news release, you have to understand that it's going to affect this chart differently from this chart. But it's going to affect this chart and this chart almost the same. And
Okay, so how do you correlate that with the high volatility, like the red folders or the orange folders?
so the how we use that is with the technical analysis. The Forex market is more technical than it is fundamentals. Okay, yeah, it does. I'm not. Whoa. I'm not saying that it fundamentals don't affect the market. No, they clearly do, or it's not wouldn't be an issue. But they affect it differently from stocks. So I typically like to say more times than not, it will follow if your technical analysis is proper. These news releases will give you the momentum or the boost off of a support or resistance. And we'll take a look at the charts. Hold on real quick. Just a second, guys.
Quick question, if you don't mind.
Go ahead.
Yeah. So your main focus is just the red and the orange folders, which I'm assuming, you know, red is for high validity,
Correct.
orange is medium validity, and then the yellow would just be low validity.
Correct.
Okay, just making sure.
So,
Right.
yeah, Corey.
Yes, sir.
So I missed the part. So I'm driving, trying to listen. I get it with the previous guy just said. He said, what with the numbers? If it's green, it ends up being bearish, or
No, okay. So with the numbers, so let's use this right here. So if it's green, that means it's good for the United States dollars. So now how that translates to the charts is you have to understand in what position is the United States currency on the point of pair you're looking at. Here on the Euro USD, it's the second, which meaning it's the counter quote currency. Here it's the base currency. So on the Euro USD, that 118 isn't the value of a dollar. It's telling you how much the euro is versus that dollar. You see what I'm saying? So if the news is good for this dollar, it's good for the dollar, and this is the value whatever we're looking at for the euro. Since this is going against the dollar, this chart should go down. This chart should go down. Since this is the value of United States dollar versus a yen, right? And the news was good, this value should go up. This value should go up. This value should go up. You see how that correlates?
yeah, that makes sense. Thank you, man.
No doubt, G. All right, so let's keep going. Pull up these charts. So what I want to get into now is we'll look at these charts. Where is it at? And then we'll go over some of the market movement and structure starting off. And then we'll point out some of those candles. All right. Let's get this off of here. You off of there. You off right there. And delete you. All right. So we're going to get a little bit deeper into the market cycle and structure. Okay. So bear with me for a little moment while I draw this up. Actually, I'm going to draw it like this. Perfect. Introduce you guys to this. Get off of there. All right. So this is a bull trend, right? All right. That's a bull trend or trend up. Ooh. All right. So we've got, drag this down a little bit. We've got a low, then we've got a high. We've got a lower, a higher low. Let me draw this brush. Got a low, high, a higher low than this low. Okay. Then we've got a higher high than this high. Then we've got this low. That's a higher low than this low. Right? That's your bull trend. That's what's delineating that you're in an uptrend, right? Now, to go deeper inside that, there's areas that we pay attention to. And at these highs and lows, guys, are the areas that I want you guys to start paying attention to. Don't necessarily worry about the numbering of the waves or anything like that, but just pay attention to a high and low. At these highs and lows, guys, is major market structure because they produced enough equity and liquidity to produce a move away from it or produce a continuation at it, okay? So what we do, there's a few things that we do. And this kind of goes along with Ryan's teaching. Test, rejection, react. If I can type. These are the three things we do. That we do and look for. We look for the retest to a structure. We wait for rejection at that retest of that structure. And then we react at the rejection of the retest of that structure. Okay. Now, what's the structure we're looking at, Corey? Right. So our entries, guys, let me explain where do we enter first of all. Okay. And we'll use this. That's what I said.
Oh, you heard me? Sorry, bugs flew in my ear.
It's all good. All right. So those shadow boxes, guys, are where we enter. All right. Now, here's the impulse or the trend. Here's the retracement of this trend. This shadow box made a higher low than this low. Inside this shadow box is where we will be reading the price action of the candles to be looking for the retest to some type of structure over here that was broken. We're looking for the rejection or exhaustion at the candles. And then once we see an engulfing or a MARUBOZU or the momentum of some type of bullish momentum, that's when we're entering. Okay. So more times than not, people take profit at that high, which is a-okay. Don't get me wrong. But sometimes the pip count from this low to this high isn't shit. You want to try to catch this whole move. So what we do, You would pop up. You fib. Okay. This 618, this top line right here, and this 272 are our take profit. So you end up catching, if you enter down here, you're catching at least to this first take profit if it's off, if it's a deep retracement. If it's a shallow retracement, you want to catch it to the 618. Okay.
How often does it hit those levels?
Almost all the time. If it doesn't hit it, it's going to retrace and go back deeper before it comes up and hit it again. And I'll show you this stuff on the chart, guys. Like we'll do some back testing here on the chart, and I'll show you this stuff. So this is the simplified version of it, right? So we look for the trend, okay? Since it's already trending, we wait for the retest against this trend. We use Fibonacci to measure the retest against this trend. We've got these three levels, the 618, the 786, and the 886 is where we like to enter at. So once price enters in between that zone, we're stalking or hawking the charts. Once price enters into structure, right? And then we're looking to buy based off of price action and ride it up to our TPs. Now, Elliott Wave comes in handy when you're looking at the trend and these retracements, okay? What I look for first off when I'm looking at the market is I'm looking for a retracement first and foremost. I'm looking to see, you know, what was the last trend? Where was the momentum at? And then I'm looking for the retracement. The reason why I'm looking for the retracement, guys, is because it lets me know where I'm at in Elliott Wave, okay? So wave 2 and wave 4, those are your retracement waves for this big impulse. These two waves, they alternate in, I would say their depth. So what do I mean by that, right? So notice how I drew this kind of, right? So from this low to this high, this was a pretty deep retracement in relation to the trend, versus this was more of like a slow kind of shallow retracement against from this low to this high. They alternate, guys. So if this wave right here was the shallow, then I would expect this retracement right here to be deeper. And this is one of the guidelines to Elliott Wave that we'll cover later down the road. But that's basically whenever I'm looking for a chart, guys, that's what I'm looking at. I'm looking at the retracement against the previous trend. So let's look at the price charts, and I'll point some stuff out for you real quick. I just had to show you guys the market movement and introduce you guys to the Elliott Wave cycle. So from this low to this high, that's called an impulse wave. This is drawn in yellow because this is a retracement. This is different from the impulse, okay? Because this itself will have another set of Elliott with inside it. And of course, like I said, we'll get deeper into that later. I don't want to confuse you guys right now. So boom, let's get this off the charts. Let's take a look at structure on a candle view. All right. So this high to this low, this is the trend to me. Until this high is broken or this low is broken, all of this, guys, is just a retracement. Okay. All of this is just a retracement of this trend. I don't know why I keep hitting that arrow. Terrible. So what I want to pay attention to are areas where price may have like hesitated or paused against the trend, right? So from this high to this low, I'm just going to mark off some stuff. Since it's a downtrend, I want to mark off the lows starting out, because that's going to be the break of structure. So I'm gonna just mark this off. And right now the colors don't really matter as far as the tools I'm using. I'm just marking up stuff for you guys. I'm also going to mark this off. Actually, hold on, let's do this. Let's do this. All right, so what I'm showing you guys now is a way to backtest using the free version, okay? Let me show you all this. It only works on the daily chart, but if you're just backtesting, guys, it doesn't matter what chart you're on necessarily. The same cycle, the same shit happens on all the time frames, okay? So what I did was just randomly scrolled back. I hit replay, and it brought up a vertical line that I just clicked on the screen, and it made all that price right here. It's no longer existent, right? So we're going to use this to our advantage, okay? So we're going to act like this is current price right here with this spinning top. So I'm going to mark up the chart how I would normally mark it up. I'm looking at this high to this low, and I'm looking at this right here. Until this high is crossed by price over here, this is structure. Until this low is crossed by price over here in the future, this is structure. Okay, because look, this is the high, kicked off a nice move. This is the low, kicked off a nice move. So I'm going to from this high to low, I'm going to mark off this low right here. I'm also going to mark off this low over here. I'm just going off of historical data, guys, right? That's all I'm doing is going off of historical data. The reason why I marked off this low is because on this move right here, it was a break of structure. The reason why I marked off of this low and this low is because this move right here was a break of structure. All right. Now, since we're going off of this high to this low, I want to fib from that high to this low. All right, I want to be mindful of where my entry zone's at in between the 618 and the 886. Up here is my stop loss level at the 1.1, which is, since this is the high we're going off of, we want to use a previous high for our stop loss level. Look where my 1.1 is. It's above that stop loss level, right? It's above that. That's a safe stop loss to use. I would actually bring it down a little bit to use it probably right here. Right? So off of this right here, guys, I'm looking to go short because the previous trend was down, right? All of this is just a retracement until this high is broken. So we're just going to mark it up a little bit more. Use a trend line tool. You can do like a counter trend line if you want to, a channel. When we'll get deeper into like the different tools you can use and stuff like that. So let me remove my fib because I already got my zone. Let's see. So now price is within our entry zone for the short, right? We're really just reading price action. I wish I could go to the lower time frames right now, but I can't. So this right here is kind of like a shooting star, right? That's the candle where small body, longer wick, 2 to 3 times the size of the body. That's kind of a shooting star. I want to be mindful of what structure over here that is bouncing off of. So I'm going to make another horizontal ray. So I'm looking at this structure right here. Or you can do it like this. Even better. Go off of historical price data over here. You know, here's a break of this structure right here. Then another break of structure right down below it, right? So notice, this is where I would say avoid, right? If you want to say something. So this has no sign of any kind of bulls right over here. Here's a retest of this structure right here, but this area right here doesn't. This is the retest of this structure that was broke right here. This is the proper retest. If I dare, that would be a lightning bolt harmonic pattern. And of course, you guys don't know what none of this stuff is just yet, guys, but I'm just kind of walking you through different concepts that I teach you guys basically in the Sherpa system. I mark up my ABC, it's in our zone, it's at structure. So what I'm doing, guys, is building a list of confluence. And this is something that we teach you to do in the Sherpa system as well. A list of confluence. What is that? It's a list of confluence is something that tells you that a trade bias or a trade setup has a higher probability of going in your favor. So here's my list of confluence right now. One is structure, right? And the structure I'm talking about is this right here and this right here. You can say that's a void structure, right? That's one. Number two, I've got this green box, which delineates our fib levels, right? It's in between our entry zones. That's number two. Okay. Number three, I can see a lightning bolt harmonic pattern or the ABC completion. That's number three. If I could go lower, I would look at the price action and look for an engulfing candle, which would be like a fourth confluence and things of the sort like that. But right now we've only got three on this current chart. So let's see what happens real quick. And some drawdown. Came right back down. Here's the retest. Wait for the rejection. Let me pause. Boom. All right. So let's look at this little formation right here. This candle right here is an engulfing candle. This is what we want to see when we trade, okay? We were already looking to go short, which is perfectly fine. It's perfectly normal, perfectly natural, okay? This prior candle is what we want to see happen. We want to see a strong push in the opposite direction of the way we want to go. And this is going to kind of feel funny at first trading like that, guys, but if you're a trader already, but if you're just now learning this, you're golden. Now, what I want you guys to pay attention to is this is where price action comes in so fucking handy, man. Like you really have to be precise with this shit. So this wick, right? Let me zoom in. I don't even think you can see it. Like, okay, so the top of this candle right here is indeed the high. All right. This candle right here, here's what you have to understand. This is structure. That high of this candle is still structure. Not only that, if I brought this line all the way over, you'll see the structure that I'm talking about. This right here. That structure right here. Yeah, this candle did engulf this previous candle right here. But this is where understanding what a proper breakup structure is, okay? So proper breakup structure, I'll just introduce it to you right now. 3 candles, of which 2 must close in the trend's favor and have a small retest. All right. So a proper break of structure, guys, requires 3 candles minimum and requires 2 of those candles being in the favor of the trend. Okay. So you're like, okay, what does that mean? Show me, right? All right. Let's start with this structure right here. Okay. Erase this, erase that. Let's move this line up to delineate the top of that structure. Boom. Okay. So this structure right here was broken right here. You see this candle? Boom. That's a break of structure. That's the first candle. This second bearish candle is a retest. It didn't even come back to really retest it just yet. So, but it's a retest. This is your third candle, guys. So you've got 1 candle, 2 candles that are in the favor of the trend with 1 retest. That's a proper break of this structure right here. Now, let's look at this structure right here. I can show this to you guys all day, right? Over here is the proper break of structure. You've got this candle that closed higher than it, which broke it. This candle, again, is higher than it. Your third candle, that's the retest, right? That's a proper break of this structure. Now, let's look at this structure, which is met over here with this structure as well, right? Now, you've got this candle right here, didn't really break it. This candle right here, didn't break it. This is the first candle that broke this structure, okay? The second candle on it, guys, immediately reversed it. And it did more than it immediately reversed it. It engulfed it. That's your change of momentum right here. So we like to see that change of momentum. So here's your change of momentum and a break of structure. Your retest right here. And now we're going to look to react over here. So let's see what happens. Speed this up. Now, before I get even further than that, right? So, oh shit, I probably can't do it. But I wanted to show the TPs. Well, let's just keep going. All right, let me pause right here real quick. So back here, I want you guys to notice something real quick, right? So down here, you've got this structure, which is a higher low than this high, right? So when this came down to this higher low, you could have TP'd, okay? You could have bought right here back to this high if you wanted to, but you could have TP'd at this structure and bought because you could have fibbed from this low to this high and you would caught this move. And all we're looking for, guys, is 20 to 30 pips at first. But let's keep going real quick. So I want to really see what happens. let's zoom out. Now I can show you, I think, the take profits. Let me see.
Uh,
What's up?
Corey,
What's going on?
that last long downtrend,
Yeah,
that would be the like a proper Elliott wave, right? That
right.
long last
From like right here,
downtrend you just
right here.
Yeah.
Yeah. Now, so what I'm showing you guys is these take profits real quick. Let's see here. Oh, no. Wrong one. I gotta zoom out. So we're almost at our first take profit. Let's just see what happens. Boom, TP hit. Right, boom, TP hit. Now, there's a method that I teach in a super advanced class, guys, that these take profits are actually where I would put pending orders and catch wick entries like this. But Gunnar, you see why we hold till the take profits now.
Yeah.
There you
But
go.
it doesn't always, I feel like they don't always shoot on that far sometimes. Like, I mean, I'm sure you can teach us something, but that's, I mean, out of all those days you just showed us, that's the first time something's shot down that,
But
tip retracement.
you have to understand, bro, they will hit those take profits, and this whole cycle runs on every time frame. So yeah, we're on the daily chart, but ignore that we're on the daily chart and look at this as like the 15. Look at this as like the hour chart, because it's virtually the exact same thing. Just the daily takes longer to play out. That's it.
Okay. All right.
That's the only difference, guys. But and this is what I'm teaching you guys, like, you know, to hold your catch the full moves. If you're going to enter, guys, like look at this ratio. Like, let's just take a look at that real quick. So let's say we entered at the 786, right? Our first TP is right there. Our stop loss was right here, right? We barely had any drawdown, first and foremost, okay? But look at this. Look at this. This is a 3.5 risk to reward ratio. That's stupid. If you hold it to the next TP, look at that. That's almost a 1-to-5 risk to reward ratio. Just guys, you just have to learn to build the confidence in the system. And by doing that, to do that, you just have to trade the demo with it. And you'll see that, what we teach you, this shit works, man. But understand that you don't even have to catch this full move. All we're looking for is 20 to 30 pips, guys, and compound. That's it. So here's how we continue with this though, right? So now that we have this low right here that was broken, I want to be mindful of that. All right, so let's see what else happens. Let's see what happens. So since this is the most recent, high to low, this is an Elliott wave as well too. Like, I'll just point it out for you real quick. Because again, guys, none of this stuff is going to look the exact same. We got this move and this move is almost symmetrical. You've got a shallow retracement versus a steeper retracement. And then you've got the extended wave. That'd be your Elliott. So this move right here, whatever comes up until this high is broken or this low is broken, all of that is just a retracement. So let's see what happens. Let's speed that up a little bit. Let me pause right here because again, we could fib from high to low.
What the hell is that?
Now I clicked on the news. That's
Oh,
1086, 786. It's getting kind of cluttered right there, but there we go. Let's see what happens.
So at that 886, you would have entered, and your stop loss would have been right above that last high.
Right above this last high. Correct. The entry zones, guys, like I said, they're going to produce enough pips for you guys to safely collect 20 to 30 pips.
TP again, boy.
Almost TP again. Like I can't make this shit up, guys. Like once I get to Fibonacci, guys, you'll understand the reasons why like this stuff happens. You know what I'm saying? Like it's still going. Like look at this. That's ridiculous. Right?
yeah.
So
Hold
at
up for a
what
couple
point do you
days.
draw a new Fibonacci?
What'd you say?
At what point do you draw a new Fibonacci after it made that new impulse move?
Correct. So this is the original downtrend we went off of, right? We saw this as a retracement. So then we fibbed from this high to, I forgot what the hell we did. No, we didn't fib at all. We entered right here and just we're letting it ride. When you pull out the fib, once we see an inside return to a trend, basically. Now, this is an inside return to this trend, but this is just minor structure. It's not like a huge retracement or anything like that. We really want to try to pay attention to, you know, more, I would say a retracement with at least, you know, 5 to 7 candles plus. A bigger retracement, I would say. Something like this. Which this retracement is just honestly the retrace from this high to this low. So once you see like this big inside return, pull out your fibs. That's just a 382, shot back down, but it didn't really break the structure. These candles closed higher than this, made a higher low. So you've got the A, B, C. Now we're looking for price to come back down and close below this low. But if it comes back down and it doesn't reach this low and starts to stutter, then you may be looking for, and it stutters at this structure, then you're going to be looking for a long situation. So let's see what happens.
So would you have entered there once it got to the 886?
What, right here?
Yeah.
Yeah, I would have entered. You know what I'm saying? I would have entered and tried to held it to my take profit. Now here's where you can either monitor it, depending on what time of day I would have monitored it, or I would have went to sleep. But it would have took me out, hit my stop loss. It's part of the game, guys. It happens. Now, going back to what I said, remember I said that once it hits off of this, it's supposed to come down and break this low. If it doesn't, it should stutter or reject around this structure. Look what happened. Boom. And guys, this is just all price action that I'll be teaching you guys over the next few sessions. It's just all about reading price action of the candles when they approach these support and resistance lines for our entries, adding it with fib and timing of the market.
So if it was to, never mind.
No. Ask it.
Oh, I was just going to say, but it kept the candles kept moving. If it would have went back down at that consolidation right there, yeah, you would have fibbed and then tried to get back in there.
So yeah, had it went back down, I would have fibbed. I'm fibbing.
Like for it to go up, like, you know, a buy.
Correct. Since this is
Okay.
the last move, and I've seen this move made a higher low than this, yeah, momentum's going up. This is just a consolidation. So now I'm fibbing from this high to low to look for an entry. And even on that,
Okay.
guys, look, even if you bought, it's hitting your take profit levels. This is what I'm trying to tell you. Just hold the trade, man. Especially hold it to the 272 because the market likes to move in symmetrical movements. And depending on where it rejects off, it's going to make a one-to-one move.
So on that fib you just drew right there, on that big bullish run at the beginning of it, your entry point would be at the right there in the middle, right in the middle of the bull run.
What from this?
Are you buying or you going long, right?
Yeah, you're going long, but let me rewind this a little.
Because you won't do it right there at the you won't do it in the middle of the bull run, would you?
No. I never buy in the middle of a trend, guys, or middle of a bull run. I want to see a retracement. So, for instance, if this consolidation is like this, I want to be mindful of that it's consolidating, and I want it to honestly go a little bit deeper into a retracement and test this support right here. I mean, yeah, well, this support or this structure right there, but it didn't. It just, this is what we call a flag, which is you got your pole and then a sideways move would be a flag. I appreciate you, G.
Can I ask a question?
Yes, sir.
So I'm just looking like, so did your Fibonacci at when it formed a W or was getting close to making a W? Would you been like, oh, I see a W coming, I can draw from the bottom up? Yeah.
Right. Yes. And that actually is something that comes with understanding Elliott Wave, because again, I'm looking. So if this was all I seen and this was an inside return, I'm looking for the ABC to still complete. So let me paint it out for you. That's a good ass question, by the way, but that's just something that we get into deeper down the road.
Nah, I just remember like when you talk about W, so I've been trying to do extra work to make sure I can see things, and then I'm like, oh.
So A, the B, and the C, right? So again, though, notice if I fib from this low to this high to catch that C move, where are my entries at, guys? Where could you have entered at, right? 618-886. Look where your stop loss is at. Your TP's got knocked out the fucking park. Now let me show you the ratio.
So your stop loss is at 1.1?
Correct. But let me show
you. Okay.
Makes sense.
So okay, because when you see the W form and you put it from bottom to top like that, yeah, your stop loss would be very, very significant versus your return.
Exactly. Your take profits, both of your take profits got hit. Look at the risk to reward ratio, guys. That's a 4-to-1. I mean, a 1-to-4.
All right. It's making sense as I look at it, but when you're talking, I'm not going to lie. Sometimes I'm still looking like this is a little bit of gibberish.
It's okay, bro. It's because I haven't went over Elliott Wave at all just yet. So once I go over Elliott Wave, like the basic premise of it, guys, like shit should start to click.
Yeah. But for the most part, dude, like it's making a lot of sense. You're not even going over it, but I can see it. Like actually.
This is all we do, guys. Catch your 30 pips, and go into the next trade. So here's another thing I'm going to go over real quick. So Ryan's thing is what? Retest, rejection, react, right? Here's where that comes in handy at. So we see this ABC forming, right? So we see this breakup structure right here. 3 candle breakup structure, clean as day, right? So we see this breakup structure. We wait for this move to happen. So if this was the current market, we see this breakup structure right here. We're waiting for this move to happen to finish out. We're not just going to buy immediately, because what we want to see is the retracement from this low to this high. And that retracement always happens. All right. And it happens to retest that structure. This is the retest that we talk about. Now, on a lower time frame, it will show rejection for us to respond and react to, that Ryan likes to say. And then you eventually end up catching this move. So now you've got this low to this high. We do the same thing again. this low, this high. We really wanted to retest this structure, but it really didn't. Reading price action, we've got this area right here is what I should have honed in on, because we've got this retest right here that pulled back significantly, which kind of set a low. Now, this low right here is a higher low than this. This low over here is a higher low than this. So it's kind of like just reading price action of the candles. Again, whenever it approaches your support or resistance, guys. And sure enough, right, it pops back up. We're just following the main trend. All the momentum was bullish. Yeah, this had some bears in it, but it didn't go nowhere. There's no momentum there, guys, for a bear. There's none whatsoever. So you just keep following the trend or follow the momentum of the previous run, and you end up catching some pips.
So my thing is like what you're showing us right here is on a daily chart. So
right,
how different does it look? Like you said, y'all do the same thing on no matter chart you look at,
bro.
But like you looking at this right here, this is about a month we're looking at.
No.
This move.
Ignore that I'm on the daily chart, guys.
Okay, all right.
Ignore that fact. Okay.
Okay. All right,
These are candles. They're just trading price action. The time frame you're on doesn't matter because it always happens, reacts the same way.
Okay.
Okay. It does not matter the time frame. It's going to play out the same way.
The time frame matters on how long your entry is going to be for, or how long your trade is going to be for.
Correct. That's what it matters. And not only that, time frame matters as far as understanding which structure is going to take priority over one or the other. But as far as the market cycle, as far as reading the price action, reading the candles, how they paint, all the same, guys.
Can
That makes a lot of sense.
I ask a quick question real fast?
Yes, sir.
That consolidation right at the top on the left, go up, move up to the left a little bit, that little tiny right there. When it went up on that little uptrend right at the tail end of that consolidation.
Right here?
No, over.
Right
now
here.
up, all the way up, all the way up. Yeah, that whole thing right there.
Yeah.
From the top of that uptrend down to the very bottom of those few red ones, you would have fibbed right there to get back in possibly.
Right here?
Yeah, because that looks like it went down like 8, the 0.81, I believe, or it's the 0.618.
Correct. So I fib from the most recent low before the breaker structure to that high. And I mean, even though it is at our 786 and 886, it's at our entry zones for a buy, right? So we could have bought right here, but we would have lost this trade. There's no shame in the game. Yo, like I said, the system's not perfect, and we're going to take losses here and there. So I mean, you would have lost this trade. But if you're proficient enough to read price action, what you would have noticed is that removing that fib after you probably would have entered down here, price was coming up and down and not really going anywhere. This is where you have to again, assess the charts, because you got this structure that it's rejecting off of 1, 2, 3, 4, right? But
reject with the morning star, would you take that into consideration as well?
Correct. That's actually an evening star. Morning star's at the bottom, evening star's at the top.
Oh, okay.
But yeah, correct. So that's actually what we went over that tonight. This pattern, right? And look what this pattern produced. So before this move though, like, yeah, you would have bought, but here's the thing. So after I see this rejection, I'm looking to get in again, right? I see this rejection, it comes back down. Okay, cool. When I see this right here, if I'm seeing this in real time, guys, this bearish candle right here lets me know something. That's actually an engulfing candle. It's not a perfect one, but it's an engulfing candle. So I'm paying attention to that. And sure enough, it doesn't cross back up above this structure. So once I see this, I might be pulling out a fib, fibbing from this low to this high, just to see, what type of retracement could this possibly be. I'm not even calling it a full-blown retracement just yet, but I see it's rejecting somewhere around a 38% fib retracement. Okay. Once I dig into fibs coming up on Thursday, guys, you'll understand that a 382 rejection produced a heavy, strong move out. And this is that move. And
And it
honestly,
hits the 618 before it moves down.
correct. Almost at the 618. Boom. Goes down. But this is another 3-candle reversal pattern. It's actually an engulfing, and it does a little bit more than engulfing. It engulfs this candle and this candle because it closes just slightly below the opening of that bull. And that's all things about price action, guys, that you all have to pick up on or begin to pick up on and learn about. Because that minute detail right there, that means a lot. Believe it or not. Any other questions?
Can you give me a definition of price action? This is a definition in words, like just like a one sentence. I know it's not a one sentence type of thing.
Yeah, it's okay. So price action is simply the painting, or well, how can I phrase this properly for you? I mean, that's a good question, man. I know what it is, but trying to explain it for you. So price action is how the candles are painting on the charts. Okay,
All right.
it's the type of candle that's painting on the chart. It's the movement of, well, not necessarily movement, but it's, yeah, that's really all it is. It's how a candle and what type of candle.
Okay.
I would say that would be price action.
Appreciate it.
Could you tell it in like a story form, like the sellers lost power to the buyers or something like that?
Okay. Okay. That would make more sense, probably. Yeah, let me think of something real quick. Boy, that's a good one. All right. So this is the current market, right? Over here. That's our current market. What we want to do is read how is the current market reacting to historical price data and historical structure. For instance, this structure right here. Now, here's the buyer. Since this is a downtrend and this is an A, B, C retracement, we want the buyers, the action of the buyers to dry up, or we want the action of the buyers to be exhausted. By saying that, we want a lot of wicking to the high that says price can't go up any higher. We want small body candles, or we want a nice heavy move that fails to properly. What? Boom. All right. Sorry about that. So again, the three things we want as far as price action on a sell, we want the buyer's action to be exhausted or tired. So we want to see wicking towards the high. We want to see smaller body candles, or we want to see a heavy move that fails to properly break structure. And that would be the price action that you're looking for. Does that help you? Hopefully it does. You can unmute yourself, by the way.
It helps me for sure.
Good. Let's see. Are there any other questions or anything?
I had a quick question. I'm probably going to go a little far back, so my apologies to everyone.
You're fine.
Yeah, like I don't know why. I feel like maybe I'm overthinking it, but when you're saying breaking structure. Could you just give me like a little recap on that again?
That's a good question. Yeah. So there's a proper break of structure requires 3 candles. All right, I'll type this out for you again. I think I have it typed out somewhere.
Appreciate you. Thank you.
Right here. Boom. So it requires a minimum of 3 candles, of which 2 must close in the trend's favor and have a small, one of those candles must be a small retest to the structure that was broken. All right. It doesn't, that small retest doesn't necessarily happen all the time, but it happens more times than not. So what does that look like, right? Let's start with, we'll start with this structure right here. All right, so we want 3 candles, which this is the first candle, this is the second candle, this is the third candle. 2 must close in the trend's favor. So since this is a bull trend, you've got a bull candle, first candle, a bull candle, third candle. 1 must have a small retest. In comparison to this trend, this is a small retest to this structure that was broken. This bearish candle has no volume or momentum to it. So that's the retest of that structure. That would be a proper break of structure to continue this trend long. So what validates this over here is this retest over here.
Okay, got you.
Y'all see that?
Yeah, that definitely made a lot of sense as far as the retest.
And it's, I mean, honestly, it's just kind of like your void. So look at this structure right here, right? I mean, here's a nice trend, nice bull run, but notice there's no bears to it just yet until over here, right? Let's see, another break of structure. This one right here. This is a good price action one right here. Let me zoom in. So here's the structure right here, this yellow line. Here's the first break of structure, a bullish candle. Second break is another bullish candle. The third break, or the third candle, is a bearish candle. Even though this is a bearish candle, this is a spinning top. This is not a 3 candle reversal. The reason being is because this engulfing candle didn't break back below this structure. So you wait for that next candle to play out. So instead of selling, like you would have thought that would have been like an M, right? Somebody would have thought this was an M, but no, kept going up. A lot of this stuff I think is can be found out in that that book you're gonna keep talking about. Any other questions?
No. Thanks, Tim, for asking that question, because somebody called me when he explained it the first time, and I didn't want to ask him again. So appreciate you.
You're good, bro. You're good.
No, I appreciate you. I'd rather look dumb right now than looking dumb in trading.
Straight up, man. Don't want to lose your capital.
True that.
So I think I covered everything I wanted to get through tonight, guys. Next class is going to go into Fibonacci, and then I'll introduce you guys to the Elliott Wave concept. I think that would help tremendously, honestly.
Sounds good.
Next class is going to be Thursday, probably. Do y'all like the 7 o'clock time, or do y'all want to do like 8?
7's fine for me.
Cool. 7's fine.
I'm digging 7.
Cool.
Oh, yeah, 7 to 8.
Yep. So I've had you guys for 2 hours, which was what I planned on holding you guys for, which is 2 hours, couple hours of class, right? Let me.
Yeah, 7 o'clock, cool, man.
Hey, no doubt. Let me see. Structure. Gotcha. Appreciate it.
What are those dots on your candles? What are those dots? Is that the EMA?
Yeah, that's the EMA that I've got hidden actually.
Oh, okay.
And then when you click on it, those dots, you can click on this as well to bring it up. It just lets you know what you clicked on and selected.
Oh, why? You have two different EMAs then.
No, I just got one.
So why the dots not on the EMA then?
It's what I clicked on. It's just so
okay.
that's what's selected. Boom. Let's see. Hey, this is a GJ. I think we was going short on GJ last night or the other day. I think. Let's see.
Yo, Wallis.
What's going on?
What's going on, my guy?
How you doing?
Yo, before you go, let's mark up AU. I'm kind of like conflicted on that, but I'm in that trade.
Are you, bro?
Yeah.
What's your bias on it?
I'm going long right now.
Oh, you went long? Ooh,
yeah, but I feel like it's going long.
Damn, here's a trade that was caught. Silly. That's just crazy. Let's get off of that. All right, so you went long.
Yes, sir.
All right, let me check this out.
I'm in at 72927. It's been like mad choppy though, so.
Oh my God. Deleted my whole EMA. Let me get some of this off of there. All right. So where you at? Where'd you enter in at?
72927.
All right. That's your entry, that first line right there.
Yes, sir.
All right. So I deleted everything, guys, right?
It's been pretty choppy though.
Yeah.
And then my EMA is kind of crossed, so I'm like conflicted now. Like, hold on, but we'll see.
I'm gonna mark this up one real quick. I'm not gonna spend too much time explaining, but we'll still get some good stuff off of it. 70. All right, these are key levels that I'm marking up on the chart based off the quarters theory. I'm pretty quick with it now because I kind of understand the little cheat to it. Let's see. I'm surprised I didn't really have this one marked up already like this. Boom and boom. All right, so now that I got those marked up, I can go to lower time frame. This is what we're looking at. So we've got this break of structure over here. Well, I mean, this structure that was broken over here. Now, she is about just, well, I'm not going to get into that just yet. Let's go to the daily. All right. Looking at the daily chart, I'm not really too concerned with all of this stuff right here just yet. I'm concerned with the most recent break of structure, which is right here, right? And then it right here. Okay. So I'm going to make note of both of those places.
All right. I got the same levels.
Damn, that was I don't want that dotted, yo. And since this structure right here is already, I guess, depicted by this monthly, I'm not even going to put nothing right there. I'm just going to let it be what it be, right? So now I can just zoom in and focus on this move right here as a whole. Now, again, ignore the daily chart, guys, and just look at the price action of the candles, guys, okay? So just ignore that. You have to look for your structure. You have to look for it to make kind of sense. This is an engulfing candle. This is what we want to see, right? That means the bulls are in control. This is a lower high than this low. Even though this shift in momentum right here, you have to understand from this high to this low, all of this is just a retest. Until this low is broken, you're still looking at a bull run.
Okay, that makes sense.
All right. And that stands true, and that's something we'll cover in Elliott Wave on Thursday too. But what I'm paying attention to, guys, is these candles right here. Yeah, this was an engulfing, but these candles right here don't necessarily have too much momentum with them. Also, we have to read price action again, okay? We see that this candle right here and this candle right here kind of broke some type of structure, but we don't know just yet until we look at the lower time frames. But I want to be mindful of that. So I'm going to put a line right there, right?
So I got a structure right there as well.
Good.
At 72924.
72924. We'll look on the lower time frame. So this is all I'm doing on my daily chart. Is just trying to look for momentum, see where the trend's at and things of the sort, right? Another thing I use on the daily chart or on my structure charts, guys, is the MACD. Okay. The MACD is an awesome indicator. It tells you a couple of different things, okay? And this is something I meant to go over tonight, but we'll hold it on until Thursday. So the way we read this is, first and foremost, is I look at the bars, okay? Because these four colors mean something. The darker the bar, and let me blow it up for you guys. The darker the bar, that means the bears are in heavy control. On the dark red, on the light red, you know, the momentum is kind of drying up. Also, I'm paying attention to, are the bars painting on a bear? Is this bar lower than the previous? Is this bar lower than the previous? That's not the case, right? We're looking at some drying up bearish momentum. Not only that, we can read divergence off of this as well, okay? And a lot of other things. So yeah, we are in a bull trend, which is what we price is showing us. This is a retracement, which is the MACD is showing us that maybe this retracement is losing its momentum. Okay. So I'll just take note of that. Just be mindful of that. So now I'm trying to find structure, basically. Where do I see structure the clearest? I'll go to the 4 hour and I see a lot of clear stuff right here, right? This top line was the structure that I said there could be some type of structure over there from the daily chart. I mean, from the lower time frame, right? I already see it just by looking at the 4 hour time frame. So we've got these three candles right here that break this structure. Here's a retest to this structure that failed to get back above it, right? That kicked off a nice little move. Over here, we got another retest to this same area that kicked off an engulfing candle. So on the lower time frame over than the day, we may be looking at another push to the low side if this engulfing right here can get below this low right here of this area. So to check that, let's see where the momentum is currently at. I could be wrong, right? But I'm not. Look what your MACD is doing. So you've had the bull run. You've also got divergence within your moving averages. You got divergence within your bars. You've got the bullishness basically drying up, has dried up. Your moving average is looking like it's about to cross into bearish territory. Price action with this engulfing already showed you pretty much what's going on, right? So this is a rejection off of a daily level. Since it's going off the daily levels, I like to use time frame correlation. I'm gonna take a look at the 1 hour so I can read a little bit better. Now, this is the highest high right here. Yeah, this, let me mark this for you. Delineate that with this. With this. All right, so this high or this structure over here was broken right here, broken right here. But again, the daily levels, not even nowhere near. It's just been rejecting. So you've got engulfing, nice momentum, broke this structure. The most recent break of structure is right here, right? So going off the daily, we see this momentum and we see that it's rejecting off of here. This is why I said this might be some structure on a lower time frame. And we see that structure now. So instead of going long, we may be able to catch some type of move down, right? So we check on the 4 hour just to look at it, see if we can see any type of structure clearer than the daily chart. And we've seen this structure from the daily chart clearer here on the 4 hour, which is fine. I always check those 3 charts, daily, 4 hour, and 1 hour. Even if I don't even use them, I always check them. Now checking the 1 hour just to see, is my bias is still, short going off of this top structure. And yeah, my bias is still short off of that. We've got a nice bull run right here that failed to break this high. This is a nice bull run that failed to break this high. This is a swing point, and we'll get deeper into what creates a swing point or what is a swing point later. But what I want to pay attention to is this high right here. Again, a clean break of structure requires 3 candles, right? This first candle broke it. This second candle came back beneath it. This third candle didn't even get up above it. This retested this daily structure and engulfed this candle right here. Little or no wick towards the top with price action only tells me bears are in control. This candle, this candle, this candle broke this structure right here. So what I would do A, B, wait for a C to come up. It may not even break this high right here. And if it doesn't break this high right here, you're looking at a 38.2 retracement, which creates a nice heavy move in the opposite direction. So the structure though, that would be first tested would be over here. This break of structure from the daily. Once it gets, if it gets above, if it gets right here and acts like it doesn't want to go any lower, that's a retest to the top of this structure, validating it as a support to bounce back up. So you may be right as far as going long based off the momentum and the trend, right? But it's now it becomes an issue of when do you go long, and it's not ready to go long just yet. It's got a retest that has to happen.
Okay, got you.
Another thing is you can reference the DXY. I don't know if Ryan and Caesar, I think Ryan and Caesar actually go over this with you for a little bit. So the DXY, it looks to be like on a nice little bullish run, right? This momentum is bullish right now, right? Go back to that odd USD.
Going down.
Correct. You're exactly correct. So it's just not time to go long just yet. It's got to finish out another, I would say, a retest to this daily level, honestly. It could go lower than that, but it's definitely going to go down. Does that help you out?
It sure did.
All right, Miss Taylor. Glad you was on here, my man. That's what's up. All right, you guys. I appreciate your all's time tonight. Thank you all for hanging out with me. If there's any questions, hit me up on Facebook, send it in the chat, get with one of us leaders of Dynasty Exchange. Oh yeah, that's what a pip. He said, now what's a pip, bro? Listen, Torrance, me and you gonna box, bro. That's my
You
home.
missed Sunday's class for that one.
Yeah. Right.